You've gone through who is going to win and who's going to lose. So who are the winners here in a Fed rate hike?
Well, really the big winner is the U.S. dollar. What we're going to see is, people going more towards, they're going to be cutting
buying up the greenback, yeah.
It's really the divergence between the central bank policies. While we're tightening, the rest of the world is easing. And so as a result, their currencies are going to depreciate, and you have to buy something on the other end of that. So it's going to be the U.S. dollar. And as a result of that, we were going to see global stocks do a lot better. It tends to be as the U.S. dollar strengthens, people start to look overseas. The people from the U.S. start to buy foreign goods, and exports from the U.S. are worth less. So it's really those two things that are going to benefit the most.
Lisa, what about people that save their money? Will they be winners or losers?
Well, hopefully they'll be winners, but it doesn't look that clear. Right now, actually, my colleague Liz McCormick wrote a story about how really the savers are not going to see that quick of a benefit because of sort of a technical dynamic in the shorter-term bonds. So they're not actually going to get that much more with respect to their returns on safer debt. That said, over a longer period of time, yes, they may be actually able to buy a treasury bond for 10-year treasury bond and get, I don't know, 3.5%, something crazy, right? Or 4%.
Or for those with certificates of deposit, for example, CD rates.
What are those again?
Yeah, okay. What about people that take out mortgages?
They actually probably have a friend in the Fed in that they're going to go out of their way to keep mortgage rates stable for as long as possible. This is a key factor for the U.S. economy. They need the mortgage market to keep going. They need people to keep buying homes. And we just haven't seen enough of that for them to really allow that rate increase dramatically.
Well, speaking about, so these low rates have been good for homeowners or anybody who's in the market to buy a house, but it's also been, right, Joe, very good for the federal government because they've been able to finance their deficit on cheap money. Yeah,
well, now it's going to be the opposite. We're going to be seeing over the next 10 years, we have people saying they're going to see about $3 trillion more interest expense, and that's going to really hurt the federal budget. So we're going to see the flip side of that coin. And then also, who also will be hurt is these companies that have been able to borrow money at really, really low rates. And if you're not taking out new loans, you're refinancing old ones at much more preferable conditions. And those are really two of the major losers that we lined up in that column for the story.
Well, I would argue, though, that with the federal government, you've got two prongs to this, right? I mean, yes, they might see higher borrowing costs. It's unclear how much their borrowing costs will actually increase because rates are not about to hike upwards dramatically all of a sudden. I mean, almost nobody forecasts that unless we see unexpected inflation. And if you have, a gradual acceleration of the economy, you've got to imagine the federal government will also be getting higher revenues from taxes and just general business development. So, there is sort of a push-pull kind of influence in the federal government, but corporate bonds, maybe less so.
Lisa, when you look at the balance sheet of the Federal Reserve and all of those wonderful bonds and assets that they currently hold, is there any plan for them to sell them into the market, or will they just be run off?
That's a great question, and people are wondering about that. They've said that they're right now going to let them run off, but people are wondering whether they would change course, especially in response to, an acceleration in economic growth that is higher than expected.
And just on a final note, Joe, the Fed is going to be both a winner, a loser, and also kind of neutral in all of this, right?
Yeah, well, the winning proposition there is that if they're raising rates, they did their job after the financial crisis. They stimulated the economy to the point where, we could start tightening again. They're losers in the sense that this is really the final bullet in their chamber. They've done everything they can. They've gone all in. They've pushed their chips to the middle of the table. If it doesn't work, there's not much. There's very few options for what they can do. And then I guess you could say it's sort of a push for them in the sense that
draw,
you could say it's a draw for them because tightening's been going on for 18 months, and this isn't really new for anybody. And we're sort of in the middle innings of it. So they're winners, losers, and they draw. So good job, Fed.